on paper, conceptually, moving to a more American-style sports ownership situation will be great for those big clubs, because right now in Europe, there are no cost controls, virtually no cost controls. You can own a major franchise and be relegated. So that is a lot of uncertainty from a business standpoint. And so on paper, they've been talking about this, I think, for close to 20 years now. But on paper, it makes a lot of sense for those large clubs. Now, it's going to cause a lot of disruption. And football is a way of life in England and countries in Europe. So I think you'll see a battle go on. But ultimately, the large city owners that are supplying a lot of those revenues, I think, want to capitalize on that and want a more stable structure.
Steve, put this in a larger context of an investor, which goodness knows Bain Capital does a lot of investing at this point. This is a different world from what I think a lot of people have seen, with so much monetary and fiscal stimulus in the United States, but also in Europe and Japan. How does that affect the investment decision? How do you avoid overpriced assets? How do you find bargains in that world?
Well, there's very few bargains in that world. We're at kind of all-time high multiples. As you know, the money supply increased over 25%, which normally leads to inflation, and the deficit is at an all-time high as well. So that's the situation. There's a lot of money chasing few deals, and that's been great for private equity, because what you have to do in private equity is A, be patient. B, you have to have a thesis when you buy a company on how you're going to improve it, make it larger, make it global, have new products. Because at the end of the day, fundamentally, people will pay for growing companies. So if you're going to pay those high multiples, you have to have a plan that's going to justify that. And that's what we do at Bain Capital. We were formed, as you know, from a consulting firm called Bain and Company. And from day one, we've been helping companies grow and prosper. And that's what we have to keep doing. And we got to proceed with caution, not get carried away to be the last one to pay the highest multiple before the crash. But you have to pay a fair multiple and then make those companies grow.
You mentioned the money supply and inflation. There's something of a debate going on between, on the one hand, I might put Jay Powell on one side saying, don't really worry about inflation that much, given for a long time it's been deflationary, disinflationary rather than inflationary. And Larry Summers, perhaps on the other side, saying, wait a second, pumping this much money into the economy, you're going to get more inflation than you think. Where do you come out on that? And how do you take that into account, if you do, when you're looking at investments?
Well, I'm with Larry Summers on that. If you look at all the data points of in any country in the last 100 years, when the money supply has increased at that level, you have gotten inflation, 95, 98% of the time within a year or two after those kinds of massive increases. So I think there will be inflation. And so what you have to do is factor that into your investment decisions and figure out what companies will be able to get through an inflationary period. So companies that can withstand that kind of inflation, you have to factor that in your models and factor that in price you pay.
You also mentioned the question of the deficit. And I really wonder, do you take into account the future strength or weakness of the dollar? Because typically when you run record deficits, trade deficit as well as budget deficit, you're going to have a weaker currency. Do you anticipate that possibility? Do you take that into account in investing?
I think you have to take that into account as well, especially if you're on both sides of it. If the dollar appreciates and you're in a highly export-driven business, USA business that exports all over the world, that's going to be beneficial to you. If you have raw materials and you have things that you're importing to manufacture, that's going to be not beneficial to you. So I would suspect we're going to have an inflationary environment, and those things will have to be factored in all of our investment decisions.
And finally, Steve, if I can ask it this way, does the Biden economy, the one that seems to be being created under the Biden administration, does it help private equity, hurt private equity, or just not matter? Are you seeing more activity?
Seeing lots of activity. What has helped private equity is there's been great performance in private equity. As you said at the top of the show, people need more yield with all-time low interest rates. I suspect interest rates are going to remain low because with such a large national debt, if interest rates go up to historical levels, if they go back to the 4 or 5%, government's borrowing at 10 basis points now. But if they go to those kinds of levels, that will be the biggest expenditure in the U.S. budget will be interest. So I just don't see how policymakers are going to be able to raise those rates that high in the face of inflation. So interest rates will stay low. People want returns, and private equity has been a proven business model to get great returns for customers.